Hi team, for this video I'd like to touch on some of the contemporary AD and AS factors that you probably want to know for the upcoming exam. So just as a bit of context to the video, consider this question from last year's exam where you need to explain how one AD factor and one AS factor cause changes to the Australian business cycle over the past 12 months. For 4 marks. So there's actually quite a lot of prior knowledge that you need to have coming into a question like this, as well as contemporary understanding of current AD and AS factors. So before we get into this specific question, let's go back to the syllabus for a moment. Factors that influence AD, these are the 6 factors that are listed in the study design that you need to know. Likewise, these are the 9 AS factors as listed in the study design that you need to know. And so basically, for a question like this, you would need to use something from these 9, and with respect to aggregate demand, something from these 6, and be able to speak to them in terms of what's happened to them over the past 12 months in Australia. So before we get into the specific factors that I'd like to look at, let's have a quick look at our business cycle to try to understand how we're going to apply these factors in context. So keeping in mind that this is our business cycle, and if we have a look at GDP growth over the past 12 months, you can see that it's been declining, and we know that at the moment it's sitting around 1.1% real GDP growth over the past 12 months. Now, knowing that the goal of strong and sustainable economic growth is equal to 3 to 3.5% real GDP, we know that the Australian economy is significantly underperforming. And so if we have a look at our business cycle, we would expect our economy to be sort of somewhere within this region. And so what we need to do is speak to factors such that we're able to support stories that would lead to either a decrease in aggregate demand, as this would then lead to a decrease in real GDP, or alternatively a decrease in AS, which would also lead to the same outcome. Okay, so let's have a look at some of the factors that have impacted the Australian economy over the last 12 months. So we'll start with something nice and simple. AD factor number 1 is consumer sentiment. Now, having a look over the past 12 months or so, you can see that although it's made a slight recovery, it's still very low. So basically, we've got low levels of consumer confidence, so a decrease in consumer confidence, which if we try and funnel that through our aggregate demand equation, leads to a decrease in C, leads to a decrease in aggregate demand. And then basically from there, if we have a decrease in AD, this signals to producers to decrease their output, which then feeds into that decrease in real GDP that we're looking for. So this is one factor that you could use to explain the current positioning of the Australian economy in terms of its business cycle over the past 12 months. The next one I'd like to look at is no surprise. It's the Australian cash rate, which we know obviously influences commercial interest rates. And so we know for a fact that obviously interest rates have skyrocketed over the past 12 to 18 months. And currently the cash rate is sitting at 4.35%. And so through your transmission mechanisms, you know that this is designed to decrease C and also decrease I, which once again leads to that decrease in aggregate demand that we then funnel through to a decrease in output as it signals to producers to reduce their production of goods and services, which once again decreases real GDP. So the steady increase in interest rates over the past 18 months certainly lends itself to explaining why we are in that sort of contractionary phase in our business cycle. And the last aggregate demand factor that I'd like to look at is the Australian dollar in terms of the trade-weighted index. We're going to have a look at the real, and you can see that there's been a steady upward trend in the real trade-weighted index over the past 12 months. And so again, I'm just trying to think, well, how does that funnel through to my aggregate demand side equation? And so basically where I have an increase in the exchange rate for Australians, that leads to an increase in our purchasing power. And so we're going to see an increase in the purchase of imports. On the flip side, we're going to see a decrease in purchasing power for our overseas trading partners, which is then going to lead to a decrease in exports. And those two things combined, once again, leads to a decrease in aggregate demand that you can then loop through to that decrease in output and that decrease in real GDP. So 3 stories on the aggregate demand side from the past 12 months in Australia that you could use in terms of explaining an AD factor. From the aggregate supply side, I'm going to have a quick look at the Ukraine war. So having a look at Russia's invasion of Ukraine, there's just some information here from a report from Deloitte. So basically we're going to focus on this through the lens of cost and production. So as Russia invaded Ukraine, global oil prices have spiked. So if we think of oil as a pretty major input in the production process, an increase in the price of oil tends to lead to an increase in the cost of production. So from this side, we're looking to understand how we can argue for a decrease in aggregate supply, because as we decrease aggregate supply, that once again leads to a decrease in output, which complements the decrease in real GDP that we're looking for. So the decrease in the cost of production as a factor of AS obviously leads to a decrease in AS, and then once again, team, that leads to a decrease in output, and that leads to a decrease in real GDP, which then goes ahead and complements that contractionary phase in the business cycle that we're finding ourselves in. The next one I want to look at is labour productivity. I only want to focus on the top half of this graph. So if you have a look here, sort of over the past 12 months or so, you can see there's a downward trajectory in labour productivity, which means that there's going to be a decrease in output per unit of labour input. Okay, so basically what we're going to see there is less output per unit of labour input, which basically means that the average cost of production per unit is going to increase. So a decrease in productivity lends itself to an increase in the cost of production, which then again feeds to that decrease in aggregate supply. And so similar to the story up here, you then get that decrease in output and that decrease in real GDP. And then the final one is also related to the cost of production. It's to do with the wage price index growth. And so basically this is trying to understand how fast are wages increasing in Australia, and looking over the past 12 months or so. I know there's a tiny little decline at the top, but the general trend over the past 12 months has been that increase. And so once again, an increase in wages growth is going to lead to an increase in the cost of production. Where we have that increased cost of production, we have that decrease in AS. And once we're at decrease in AS, we can then argue for a decrease in output and a decrease in real GDP, which once again lends itself to the aspect of the business cycle that we're currently in, as per where we started in this video. So I'm hoping that that gives you a little bit of context. You've got 6 factors that you could speak to, 3 AD and 3 AS. Have them ready to go, and it doesn't need to always be with respect to the business cycle. It could be also with respect to the achievement of the macroeconomic goals. It could be to do with living standards, but just a quick snapshot of some of the things that have been happening in our Australian economy over the past 12 months. I hope that's helpful.